I think if we were to sort of talk about the global environment, and I'll start with this slide, which actually pinpoints what's the macro picture globally. You do have, essentially a barbell approach to the world. First of all, the U.S., despite the fiscal cliff everyone's talking about, is probably in a much better position than a lot of the commentators actually are talking about. What has been counterproductive or not as productive as expected is this $6 billion spending in the various elections, which actually didn't really change the picture that much. Asia, even if China, we're talking about slowing growth in China, I think people are probably more worried than should be warranted in the emerging markets. We are seeing some slowdown effectively, but essentially on the back of slowing growth in Europe. And the key problem, or the sick man of the world, I should say, is essentially Europe. We've had some positive sentiment in December and January of this year, but that rapidly dissipated. We've had some very significant moves, and I'll come back to that. And everyone was talking about something that looked like a game changer in July with the ECB and Draghi plan. But I'm going to sort of explain that, again, this is not really a game changer. And the banking market is, of course, over-leveraged, and that is probably a drag on prices, a drag on growth, but also offers interesting opportunities, which I'll try and touch upon. I've borrowed the next 2-3 slides from my colleague in the US, Mike Acton at AEW Capital Management. And as you'll see, when I heard him, we were in New York about 2 weeks ago, talking to US investors. And I can tell you they're worried about Europe. They're interested. They're monitoring the market, but not ready to move really massively yet. And I think the most important reason is that they think the market will rebound more strongly in their own domestic market than actually in Europe. They think it will take time. And one of the reasons where they're actually more positive than what we may think is that despite this fiscal cliff. Now, this is really a cliff. If these are just 5 or 6 of the key items that could change and could essentially have a 4 to 5 percentage point drag on U.S. growth next year. That's what everyone's talking about. That's what the key discussions with the newly elected president and the opposition, the Senate, and essentially the Chamber of Representatives in the U.S. is, we have mandatory 10% cuts. That's $100 billion. We have nearly $300 billion of the Bush tax cuts. These are all coming into renegotiation and discussion by the end of this year. So all of this put together, and the debt ceiling extension could actually be a drag of nearly 5 full percentage points on the U.S. growth. But everyone actually believes there will be some deal being cut by the end of next month. And that could actually lead to 1.5–2% drag on growth, and essentially keep the momentum going in the U.S. And one of the key reasons for this is that the Fed in the U.S. is actually has committed and forced the expectation that quantitative easing is there to last. It's there. They've actually said that they will do quantitative easing as long as the U.S. economy does not actually generate sufficient growth to pull the unemployment rate back to normal or long-term average levels, and actually forcing some of the investment into risky assets. So they're actually enforcing 2 convictions within the market. First of all, interest rates will stay low. Inflation is not a short-term phenomenon. Inflation should not be expected in the near future, not 2 years, not 3 years, probably longer term. That's 2015, and that's exactly what the Fed members have actually voted upon, and they want to spur consumption on the back of some positive news from the residential and housing market. Now, this is probably the reason why I took this slide from my colleague. I just love this little thing, and he kept it on for a long time, so people were actually at some point distracted. So I'm not going to leave it there too long. What essentially this says is this is probably the reason which makes a lot of U.S. investors positive. They know they're going to have cheap money for a long time. So anything that spurs growth will actually feed into their returns. And if you look at the right-hand side, which is probably the most important here, it actually pinpoints where the expected changes in Fed policy, that's the members of the voting members of the FOMC members, they think inflation will eventually kick in at the back end of the forecasting period, i.e. 2015. So that's the good news on the US, and it could be, to some extent, good news for us, because we're going to, to some extent, benefit from this. Now, what could go right in the US? This is also, I think, a feature of US investors' attitude towards risky investments. They look at the silver lining, what could go right, instead of just focusing on what could go wrong, as we most of the time tend to do here. So I have a sister slide for Europe. It took me a while to put it together, I have to say. Essentially, the beginning of North American. I think this is something that really makes people positively look for the future in the U.S. This energy paradigm shift, essentially saying U.S. will have energy autonomy by 2015, 2017, and probably be a net exporter of energy. This is really changed, flipping the mindset of investors over there. Maybe we're overshooting the expectation, maybe not. Housing is actually turning the corner. It's the best performing asset class in the U.S. And housing prices have actually recovered, are beginning to recover in a lot of key metropolitan areas. And that spurs into psychological and confidence shifts. People are not, institutions and corporate U.S. was not actually hiring because of the expectation of the U.S. election, because of the expectation that the fiscal cliff could go wrong. Things are changing. Psychological and confidence shift is actually taking its grip, and the expectation is that for the as soon as there's white smoke in Washington, there'll be some positive move to kick in the second gear. So and of course on the back of strong corporate balance sheets in the U.S. So all of that, I think, paints a relatively positive picture for one of the key regions in the world who will benefit most in Europe. Probably the UK to a large extent, probably Germany to maybe a lesser extent, but positively, and the rest of Europe if the first two actually recover quickly on the back of that. Now, that was for the positive news. Now let's talk a little bit about Europe and the European Union, I should say. I think the latest discussions were actually about a Brexit. We were talking about Grexit in July, Greece exiting. We're now talking about Britain exiting, not the Eurozone, of course, but the European Union. That's not necessarily good news. This is the weighted, on the right-hand side, you have the weighted European peripheral bond spread, over the German Bund. And the higher it is, the highest the risk aversion. And it has gone down very strongly right here. And that's essentially Mario Draghi coming up and saying, I will do anything and everything it takes. And I've put a plan together. This is a decisive step. We'll step in and buy short-term peripheral bonds. For the moment, we haven't seen €1 into this program, right? But it did have a positive effect on the mindset of investors, and it has fed into very positive numbers and performance numbers for risky assets, and equities in particular have done very well since that announcement on the 27th of July. The first thing was the LTRO, that was short-lived. The second was the Draghi plan, that's the OMT scheme. And then, of course, we've had the German Constitutional Court actually ruling positively on this, so that was really, again, a positive. And if you think about it, it's a pledge from the ECB to buy unlimited, and that's the most important point, unlimited amounts of peripheral bonds and enforce, and of course, remove any of the seniority concerns we had in the previous plans, which were, just awkward. So, just without going into too much into too much detail, the crisis has been averted. That tells something about my mindset. It has removed a lot of the short-term risk and actually the downside tail risk of risky investments, and boosted, the short-term bond market. Now, one of the things I just want to leave you with is this is all good. It works well. It's a relatively well-thought plan. The problem is that it doesn't actually concern those countries that actually need it most. So the Greece, Ireland, Portugal have actually been left out. And it's essentially a plan aiming at Italy and Spain, and to keep them afloat and to lower their borrowing costs. So it is a positive, but it is conditional, so they have to ask for help. And the most important thing is that the weaker countries have been left out, which means that these countries, the probability of them leaving has actually heightened. Actually saying we'll do everything to keep Spain and Italy in means that we may do this at the cost of having the weakest countries actually exit. So our house view here is that we think nothing much is going to happen till the German election. We're going to see what happens in Italy in April for the election. Things seems to be changing. We don't think we'll have a Eurozone breakup in the by next year. We have to wait for the German election. So it is not a game changer, but it is a positive, and it'll keep things together. And it's essentially having Angela Merkel move its focus to a more domestic focused agenda than actually a more pan-European way of changing the organization. So what does this tell us about growth? Essentially that we will probably in the Eurozone go for a slightly negative GDP growth this year, and not maybe better next year, but probably near zero real growth in the Eurozone, and actually a drag on consumption. So it might be interesting to discuss during the panel about what we think about retail in that context. So all roads lead to Germany. What would be the price for rescuing or fixing the Eurozone? Italian and German election, I've talked about that. Europe will continue to struggle and just move forward. I think just kicking the can down the road for the next 4 quarters. That's our conviction. And we'll have a near zero or mild contraction next year. Longer term, the implications of this scenario. This is taken from Oxford Economics. This is an interesting chart, because what it actually tells you, this is long-term growth in the 3 main regions. Eurozone, US, and the light blue is the BRICS. The largest emerging economies. The expectation of their model, their global model, is that these 2 regions will grow above trend, and actually this will be accelerating as of next year. This is a very good news. So it will drag positively, or pull, I should say, instead of drag, the Eurozone, but way below trend, and will only go back to trend, which is 2% real growth, at the back end of their forecast period. So we're in for some time into this sort of slow growth environment. And the interesting thing also on this table is that the UK will be doing better than the Eurozone. So essentially, the other takeaways from this is that will allow heightened inflation expectations in 2016-17. EU real GDP contracts for the best part of this year and next, so we're bottoming out, and the Bundesbank will allow the ECB rate to use a little bit of its ammunition next year. Unemployment will peak in 2014 and 15. Okay, so we may discuss this later on. And the rebound is actually not before 3 to 4 years' time. So what we've done, and this is a graph I'm taking from one of the client presentations we do, because we often get the question from large investors from Asia Pacific or the US. Okay, now that you've told us everything about this, where do you what would you invite us to invest? With all this doom and gloom. So what we've done is we say, yeah, but it's a combination of economy, real estate markets, and forecasts. So let's do this in one graph, and I think that's relatively interesting if you do that. We've done a scoring of the different EU members, and this is the macroeconomic strength of Europe. And as you can see, you can see there's a ranking in here, but what actually comes out is that you have countries like Norway, that's the north of Europe, Switzerland, Finland, Germany, Denmark, actually, sticking out their necks in this hierarchy. But it doesn't mean that this is the best places we would advise to invest in, because if you add to this stack a view on their structural real estate strength, and that's a function of liquidity, international investors, the historical performance, transparency, indexation features of leases, etc., then you begin to have a little, slightly different picture. And in here, the UK, Germany, and Austria actually begin to stake out of this analysis. And then the third bit, which is probably the most difficult to get your hands on, is the forecast. If you add to this, then actually what you do see is that you have two countries that actually really stand out in this environment. That's the UK and Germany. France is a close third, but it's actually, if we updated these numbers right now, we would actually have France slightly going down in this picture. And then you have a group of countries which are what we call Group 2, which actually comprise some of the smaller, more open economies and that have better expectations. And what about France in here? France actually, if you look at ranking these countries within a map, France is actually the only one with this particular rank, which is just below the top 2 and way above the rest of the European economies. However, I think you've all noted this. This is what most people have been talking about lately. What's going on with it has a central position. People have moved from the UK in the 80s. We've talked about in the late 80s about the Nordic countries, which were the sick men of Europe. We're talking with Denis Francois during the coffee about Germany during the late 90s, early 2000s about being the sick man of Europe. Then we quickly switched to Italy, and then no one talked about Italy anymore, and now the focus is on France. And it hasn't been the only point in history where the Economist, which is a very highly regarded and well-read, has been talking about what's going on in Italy. So we'll talk about that during the panel. So what could go right? This was the one slide I struggled about. US and Asia, I mean, if we have the expectation that they'll grow above trend, there is no reason why they shouldn't pull out the export-driven economies of Europe. That's a positive for Germany. So Germany should be able to benefit from heightened consumption in the US and Asia. So, and if you look at the trading partners of Germany, you find all the Group 2 countries of Europe. That's France, that's Central Eastern European economies, and to some extent the other countries like Italy, for example. We think the Eurozone has ammunition. I mean, there still are. There's a case of ammunition to actually pull the Eurozone together and keep it together. Probably more bailouts. We're talking about bailout for Spain. A positive move, of course, is the NAMA-like bank that's been put together in Spain. I think that's a really positive. It's coming late, but it is nevertheless coming. Renegotiation that's actually going on right now in Greece. It hasn't led to anything very concrete. A mini bailout for Italy, probably linked to the south and the south of Italy, not necessarily the north that doesn't really need any help for the northern part, and probably a new bailout for Portugal next year or 2014. And of course, moving to a more fiscal and banking union, so changing the rules of the game. So what we don't want is anything that again comes in like that. I don't know if you remember this one. Now that was the first one which I really thought was more provoking than the one we just saw, because we've had 3 major reports on France: the IMF, we've had the Rapport Gallois, and we've had the report from the Economist, and I think they all point to the same direction. They were a little bit late, and a number of things have been done in the meanwhile. What was actually true was that most of the campaign did not really address the issues that we're addressing right now. That was probably more to the point than the previous picture. Now let's talk about real estate quickly. I'll move on. I hope I'm on time, Richard. Yeah?
It's fine.
Yes. Fine. Okay. Probably one of the most interesting developments in Europe that we've noted last 2 years is debt finance. This is an interesting graph thanks to IPD and the Bank of England. This is capital growth on an index base, and luckily in the UK we have very long time series, and we can go back to the early 80s. And the red bars are UK net lending to property companies. So we have this statistic running back to the early 80s. And look, just visually, without doing any computations, you see the correlation. You can call it correlation, and you may want to call it causality, right? You may want to say, who actually is this blue line driving the red line, or is it the reverse? And I think it is a question of both, right? Because in the different parts of the cycle, if you have increasing capital values, you can actually get more debt, and if you have more debt, it also fuels increases in capital values, right? And when things go wrong, actually, then they actually go wrong together. So the link between the two is fairly easy to establish. Now, what there are a number of observers that have used various ways to address the so-called funding gap. Without going into detail, what we've done here, we've taken the EU balance sheets of the banks' balance sheets, UK and Eurozone and the rest, and we've done a reverse calculation from what the CBRE and others and the ETZ have been doing, trying to address the funding gap. And the most important thing is we have used an estimate from the IMF. The IMF publishes, I think, semi-annually, Global Financial Stability Report. And in that report, in April of this year, they said that European banks would have to shrink their balance sheets by at least 7.3%. So we've plugged in that number on the volumes of CRE, commercial real estate loans, and we ended up with a very hefty estimate of alternative sources of debt. So and the net funding gap was roughly just south of 150 billion euros. Okay, so that's approximately 1 year's worth of European transactions. And then, unfortunately, in October of this year, they came up with another figure. They said, no, sorry, it's not 7.3, it's 12%. European banks will have to shrink their balance sheets by 12%. And we've plugged in that number. We didn't really change the estimate because we knew it was very optimistic of the alternative debt targeting real estate. That number actually doubled. Despite the fact that we've been hearing very relatively good news on the listed property companies being able to issue bonds at very attractive loan terms, that's all good, but it's targeting core companies and core assets. The rest of the secondary is actually widening. So we've talked with investors. Maybe some of you know we've launched a debt fund. And the attractiveness of a debt proposition for large institutional investors is that if you look at the lending terms, I'm not sure this is accurate. We can debate it. This is taken actually from a lot of it from CBRE. The proposition for investors is interesting. Senior debt today in Europe is an attractive proposition for a number of reasons. It's the new super core. And investors would see this as being a 4%, 4.5%, even 5%, depending on the leverage and the type of property you finance. And it's attractive because if you compare that to a super prime in Europe, in London, Paris, or Munich, then you actually have a good proposition. What's more, even if you don't have indexation, you have the ability to get your money back in 2, 3, 4, 5 years time, and then redeploy that in an attractive, or hopefully more attractive market in 3 to 5 years time. So what we think is that if you look at investment volumes, these are graphs in France, the UK, Germany, comparing cumulative investment volumes in 2009, 10, that's the black line, 2011, and then the cumulative investment volumes from January to December in these countries. If you look at, maybe you start with the UK. UK has been relatively on track over the last 3 years, and we're going to end up somewhere with 30 billion, 35 billion euros worth of transaction. Very liquid, relatively stable, very transparent. France, we've had this kink last year with the end of SIC 4, right? So that actually spurred a lot of investments at the back end of the year, and we're relatively on track with what we had in 2010. Germany had an exceptional year last year, but we're dragging, we're below what we experienced last year. And probably the most dramatic situation is what we are seeing in Spain and Italy, with volumes this year way below even when they were in 2009, just after the Lehman episode. So these markets have now become opportunistic, even from their corest assets, and that's where I think the theme of risk aversion and the flight to safe havens. I mean, you've titled that in your magazine on several occasions, and that's the illustration that we're seeing here. If you look at investment volumes, of course, I think you all know these numbers. We roughly have 20 to 25 billion euros worth of transactions every quarter. That's approximately half of what we had in 2006, 2007. But maybe the most important graph is this one, where you see London Prime and Paris Prime actually going at historically low levels of yields. And the reverse, the French regions, the UK regions, going the opposite way. And the peripherals, this is a weighted average of everything. That's not these prime markets. That's actually going north to 7.5% and more. So we're actually buying assets relatively, we think of relatively good quality in provincial UK, in 150, 200, 300,000 inhabitants, retail, and we're buying that at 9%. So that's, the thing is, what's the definition of core in today's market? Today the market is telling us core is just, the super prime in those Western European countries. We don't think this is a definition that's here to stay for the next cycle. So just to wrap up, what kind of deals should we be executing in this environment? Essentially, if I just summarize what I've said, and then I'll have a wrap-up slide. Strong risk aversion, but that doesn't necessarily mean wait and see. We have seen a lot of investors. I think one of the phenomena that's been underestimated is that institutional investors have been taking risks on their existing assets. If you had an asset in Paris, a Haussmannian building needed restructuring, institutions would actually put the money to do that and release. We've seen that, but it doesn't really appear in transactions data, right? Because it's their own standing investments going into a development phase. I think this is coming to an end because you have so many assets in your portfolio that can be converted to core. They've been doing this in Germany, they've been doing this in the UK to a large extent, but that's coming to an end. So major property markets in Europe are actually stable initial yields. And what I actually tell institutional investors from outside Europe is that if you look at Europe, it's actually good value. IPD tells us that core institutional real estate in Europe yields a 6% NOI on average, right? Not the prime end, but on average. And if you compare that to senior corporate bonds, that's 2.4. And if you compare that to a blended UK, German, and French 5-year bond portfolio, that's just 0.8. Doesn't even cover inflation. So you do have a relatively attractive. But they say, yeah, that's true, Mahdi. But we can get better deals in the US or in infrastructure in Asia for the moment. So, however, the interesting thing is that cross-border investments are on the up. I think a lot of people actually pick that up. And maybe the main risk and opportunity is the 200, 400 billion funding gap, with a lot of funds actually expiring in the next 2-3 years. Look at the INREF data. That yields an interesting story. And an opportunistic approach. Essentially, don't bet on growth of rents. But you can actually convert to core, either by the definition of what's core. It's now treated as secondary, but actually it is core. It has been core for a long time. Just now it's off the radar screen. So finally, I think this is what I want to leave away in terms of ideas with you, and then talk about it on the panel. Is our view is that either you go for super core, and including debt, or you go for opportunistic. And I struggle to find attractive investment opportunities or solutions on the value-added side, where we do have, this is actually packed up in Asia. This is packed up in the US. Packed up in the US, you do have very interesting opportunistic investments. I can tell you that more than 80% of the deals we did in the US on the opportunistic strategies, the seller was a lender. And I think this will come gradually in Europe. I'm not going to go into too much detail, but probably the interesting maybe we could discuss is, we do see interesting opportunities in Europe for the opportunistic side of things, and not necessarily in France, not yet. We haven't seen a lot of distress. We haven't seen a lot of liquidating funds. So the ones we've seen actually had held core assets, and they've been snatched up by very, low gearing institutional investors. But we do see things actually unfolding in the UK and Germany, and to some extent in Central Eastern Europe.